So now we turn to Asia and specifically China. So when we look at what has happened in China right now, we always talk about the law of diminishing returns, and just a quick 1-2 on what law of diminishing returns says. It just means that for every new level of cash injected, you're getting a diminishing util or what the impact will be to the economy. And eventually you get to a point where every additional dollar actually has a negative util, which just means it has a negative impact. It's not going anywhere. If anything, it's actually pulling down activity, making things worse. And realistically, China is hitting that point because every new dollar that's invested is losing money, which is called a negative multiplier, which means typically you want a multiplier over 1, which means that you're actually making money. For every dollar invested, you're going to make over $1 back. They're averaging something closer to 0.88 or 0.86, depending on the metric that you use, which means for every dollar invested, they're actually losing between 12 and 13 cents, which means they are not making back principal, nor are they, forget interest. It's just a matter of getting their money back. And here's looking at some of those low return on investments. Infrastructure projects in China, nowhere close to paying for themselves. And this is what we've been talking about. This is based just on 2020 data, but we've shown it going back to 2019 that you started to see a degradation of just payback for these projects because they kept throwing money after projects. Now, sure, some projects get much better and you do the good ones first, the ones that are going to make money. But then as you keep wanting to drum things up, it gets harder and harder to find valuable projects that will actually yield something of value. And here's where you look at the income from special bond funded projects, but yet look at the interest payments on that special bonds. You can see everything is steeply underwater, and these are just a sample of some of the areas around the country. There are more than 3,000 individual administrative units in China, with 33 provinces, 333 cities, and almost 3,000 counties. Many of them use companies, or I should say structures that are called local government financing vehicles, or LGFVs, to borrow money to pay for infrastructure and other services that can't be paid for on the official budgets. So now you actually have the PBOC and the CCP going and doing audits. And you'll be surprised to know that there are way more LGFVs off balance sheet than there were initially reported. So now the central government officially denies that government is responsible for these debts, but investors and banks lend to the LGFVs at low interest rates because it's assumed that local authorities won't let them fail. And again, it's a communist country. Typically the last person to pay for everything is going to be the CCP, and it'll just keep rolling up. Now, will that be the case? I don't know. But again, this is what is the expectation. So the Ministry of Finance data showed governments across China had 37 trillion yuan, $5.1 trillion in on-book debts outstanding at the end of April. But there's no official total for how much hidden debt is there. And I can assure you it is much bigger, especially when you start looking at, again, where some of these key pieces are. Outstanding loans to small and micro businesses in China, China exploding loan values to small businesses, rapidly rising delinquency rates. Continue to look in terms of where things are because delinquency rates are going up, but yet the government's saying, oh, don't worry, we're going to lend. We're going to lend some more. But how can you lend some more if the delinquency rates are increasing in general? You're continuing to see that problem, but yet you're going to lend and they're going to borrow. That's not how this works, especially when you're not making any money on these investments. If anything, you're losing money on these investments. PBOC did take down the prime rate by 10 basis points, the 1 year and the 5 year. The estimate was that the hope was that was going to drum up some activity, but again, they've continuously cut rates. Now they're talking about, cutting more taxes. And look, going back to 2019, there has not been a period where they raised rates. So they cut rates through 2019, they cut rates in 2021, they cut rates again in 22. So again, the law of diminishing returns, at what point does this start to catch up? And that's why we think it's here. Now, it's important to look at what the PBOC is doing, trying to really buffer the problems. And our view is that they're not trying to drum up growth, but just support what's already there. And that's why we do see China growing. We're not saying they're not going to grow, but it's going to grow closer to 3% and not this 5-6% that has been out there. Now, over the past month, there's been two different settings. Xi has urged officials to prepare for extreme scenarios, and people have misread that as extreme scenarios. There's going to be war. There's going to be this. It's like, well, no, he's been saying this for years. So he's been saying since at the May 30th meeting for the party's Central National Security Commission, the complexity and difficulty of the national security issues we are currently facing have increased significantly. National security apparatus must adhere to bottom line thinking and extreme scenario thinking and be ready to withstand high winds, choppy waters, and even dangerous storms. That's very consistent. That's an eloquent way of saying it. He said it before. Again, nothing has really changed. The Blinken versus Xi meeting, again, everything is very much status quo. Blinken came out and said we don't recognize Taiwan as its own entity, which is still, again, one country, two systems has been something that we've talked about multiple times. That's not going to change. It doesn't mean that we're not going to defend them. I know that the news ran with we're leaving Taiwan behind. I can assure you we are not. That is not the case. We have Marines on site. We have a lot of viability. Again, it's just this is political theater. At the end of the day, China needs us to our foreign direct investment. We need China to devalue the renminbi so that our imports get cheaper, helping the U.S. economy from bringing down, in order to bring down prices. That is what continues to happen. Now, on the dual circulation strategy side, the purpose of building large domestic circulation is to ensure the nation's economy can continue to operate normally under extreme circumstances. That is not contradictory to participating in international economic circulation. Again, they've talked significantly about ways to drum up, drum up the means of dual circulation, but they have not been able to do it. Common prosperity, same thing. China's talked about it. Xi wants it, but it hasn't been achieved, and it seems very difficult to do that, especially given the levels of losses that the consumer has taken. Economic indicators, I thought this was a really good summary showing you how things have continued to cool. New housing starts getting worse. Home sales by floor, diminishing. Exports rolling over. Fixed asset investment slowing down. Retail sales slowing. Industrial production slowing. All of it is showing that, again, that decline. And what the PBOC is trying to do is like, look, we can't bridge that gap and bump it higher, but we're going to try to slow the decline. And that's when you look at that early strength in property and exports have all started to reverse over. And that's why we continue to see these pressure points. China local fiscal revenue from land sales year on year down over 20%. And that's, if you look back through time, they were using those land sales in 2020 and 2021 to help buffer those LGFV loans. Now that has gone away, as tax revenue continues to get pulled away, what is going to backstop this borrowing? Because the PBOC has said, the CCP has said, you have to lend. To who? Manufacturers have been shedding jobs since mid-2022. So not only are you reducing tax rates, you're also losing taxable income as more people struggle to find jobs, as more jobs may leave China on that nearshoring, onshoring side, with China being the most impacted country with those jobs moving to other sites, again, pulling away tax revenue while the government tries to drum up more support. Money supply, loan growth, and credit creation weakened after that reopening recovery. And that's what we've been saying. It's like, just because the loans are available doesn't mean anyone's going to take them. And this is being reflected in M2, in renminbi loans, in social financing. You're not seeing any meaningful adjustment except for government bonds, which, if you remember, we've talked about the state-owned enterprises, the SOEs, are just churning them. So they're taking these new loans and just paying back the old loans, and they're getting a slight discount to do it. And they're going to continue to do that. But on a corporate side, nothing. There's just no corporate bonds because the private side doesn't have that opportunity. And realistically, based on Xi's commentary and his reliance on SOEs to drive the quote unquote future of China growth and innovation, you're not getting that support. Now, on the other side, he says that's not true. But again, just looking at the movement of money and where that support is, you continue to see it going into that government front. China sales for a manager index for the service side is coming closer and closer negative. Again, that deceleration of activity is going to pick up. Business confidence worse. Market growth is now negative. Sales growth diminishing, still positive, but falling. Prices changed in deflationary territory, bouncing around. Staffing levels essentially flattish. But again, all of this is compressing those profit margins, which is why with those profit margins, can you really take on more debt to pay off those interests? Can you really hire people? And again, this is where we continue to see this underlying slowdown. China sales manager on the manufacturing front still in negative territory. Business confidence negative. Market growth still in contraction. Sales growth now falling into contraction. And remember, sales growth was positive and you actually had a slight little bounce. That is now corrected. Prices charged, staffing levels, right in line, but profit margins compressed much further based on where we are on that sales growth side. Sales growth was giving this confidence that sales were still going to stay strong, and by volume, they were going to be able to protect some of those margins. Well, now as sales growth has diminished, so has the ability to generate those profit margins. China foreign direct investment coming in steeply negative. You could see steep decline. You can see that it normally declines here, but it obviously outpaced where we were in 22 and 21. And we expect to see a much softer bounce, which typically happens in the summer months. And we are getting a similar divergence when you, in terms of where manufacturing and non-manufacturing is when you look at the PMI side, because the foreign direct investment was really supporting the manufacturing. That is pulled out. Now you're just relying on services, and based on what we just talked about on the service front, we see that actually accelerating faster to the downside. We've already seen it break down in the U.S. based on what the Philly said, what Philly Fed has said, what some of the early indications are for the sales growth, and we see something similar coming into China. Now, South Korean exports, fairly flattish. You could see that there's typically a bit of a lull, things held fairly firm. Taiwanese export orders were expected to come in at negative 21.3, actually came in at negative 17.6. But you can see it's just bouncing off the bottom. And as we've been saying, it's just, again, bouncing in this contractionary standpoint. But as the renminbi has cheapened, it actually makes Chinese exports a bit more competitive, which would be a negative when you start looking at South Korea, Taiwan. South Korea, Chinese political issues have flared back up. Again, right now, it's just kind of name calling. South Korea called their Chinese embassy to answer for something. Again, so far, just a lot of political staging, but not any real impacts in the near term. And then finally, when you look at Vietnam, has grabbed market share as an electronics exporter. That's going to continue. And for anybody that's been following us, we said Vietnam was going to be a natural landing point for companies leaving China and leaving some of the other areas, to be honest. Taiwan, South Korea, Japan. It's cheaper. There is still very intelligent labor there that can do the job. And we do see Vietnam as continuing to take some of that market share. Now, when we look at some of the winners, the index XIT, when you look at IT sector and country index, Brazil and India are among the emerging markets that are doing well away from just looking at the tech sector. Not surprising when you look at Brazil. Brazil has had some bumper crops over the last year. They had some massive sales increasing into China on the bean side, on the corn side, on the meat front. And then obviously they've brought on more and more oil and oil for the most part at this point, which has, again, increased their exports, made them more a bigger focal point. And then on India's side, India has taken on, again, more manufacturing. More manufacturing has moved into the country, which is enabling them to continue to succeed even when you take away the technology growth that has happened there. So that's what we have for you on the Asian front. If you have any questions, please let us know. We'd love to hear from you. And we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.